Welcome to the Allan Small Financial Show. As always, I want to thank everybody for taking some time out of your busy day to spend it with us. We have a jam-packed show for you this afternoon. A lot has happened since we were last together a couple of weeks ago. A lot of things affecting the stock market, individuals' portfolios. Number of questions I've been receiving from many investors over the past weekend, over the past 2 weeks. And again, as always, we want to bring the answers to those questions to you on our show today. So here's a list of some of the topics, or all the topics, I should say, that we're going to be speaking about. Market reaction to what's gone on in the Middle East over this past weekend, the Iran-Israel escalation. We're going to touch on, again, as always, the top 3 things that I think are important for individual investors to consider before you make your investment decisions over the next couple of weeks. We're going to delve into U.S. bank earnings. How were U.S. bank earnings? Primarily, this has been really the only sector, with the exception of maybe some U.S. airlines, that have reported earnings so far this earnings season. Most of the big banks in the U.S. have reported earnings, and I'll give you a clue or a little hint up front. They all did pretty well. Investor expectations. Coming out of the first quarter, the S&P was up 10.5%. The NASDAQ up 9.5%. The Toronto Stock Exchange, our market here in Canada, was up 6.5%. What expectations should you have as an investor? Can we maintain 10.5% growth per quarter for the rest of the year? Well, probably not. That would be nice if we could, but what should investor expectations be? So we'll get into that. 5 things that could take down the markets if something should go awry. There are 5 points I wanted to make, 5 things I wanted to discuss that unfortunately, if something goes wrong, that these things or these topics or ideas, unfortunately, could bring down the stock market here in North America. And we'll touch on each one of those 5. Canadian budget highlights. Now, of course, the Canadian budget was released last night or late yesterday afternoon. Haven't had time yet to go through everything, but a couple of things are standing out. Couple of questions I'm already receiving from individual investors. So wanted to highlight just a couple of things that I think are important. And perhaps anyone who has any questions on the budget, you could put those into the chat boxes, and I'll do my best to either answer them at the end of the show or answer them over the next few weeks before the next show. So without further ado, let's get on with the show. So market reaction to the escalation between Iran and Israel over the past weekend. And, the markets actually, I think, took it pretty well. It really wasn't until the Israelis said that they would retaliate for all the missiles that were sent from Iran directly to Israel. This was the first time that Iran itself sent these missiles to Israel. Usually, it's their proxies, whether it's Hamas or Hezbollah or anyone else, the Houthis in Yemen. They're the ones that seem to be attacking Israel. But this was the first time that Iran actually, sent missiles, sent drones to Israel directly, which, of course, as many of you know already, were stopped, and only a very small percentage got through and landed in Israel. But the Israelis say that they will retaliate. And it really wasn't until they said they would retaliate on Monday that the market sold off. Coming into Monday morning, I thought we'd see a spike in oil, which we didn't see. We would see the markets down significantly, which we didn't see. It almost was as if, well, Iran did what they did, but it didn't really cause any damage. And so perhaps Israel came out on the better end of things. But now that Israel is saying or vowing that they will retaliate, I think the market is now on watch. And I think investors are on watch as well, a little bit nervous. Obviously, the uncertainty that a war brings, whether it's in the Middle East, whether it's the war in Ukraine, between Russia and Ukraine, or any war around the world, there is obviously a lot of fear, a lot of uncertainty. And that usually plays out in the stock market to the negative side of things. And you tend to see gold spike when something like that happens, because gold is that investment that everyone flocks to when there is uncertainty or people are nervous about something in the world. And so people move to gold, move away at times from the US dollar, or actually even move into the US dollar. I've seen the US dollar, which is a good fear gauge. People tend to buy US dollars when they are fearful. At the same time, which is a bit contradictory, they also can buy gold, because gold priced in US dollars usually moves higher when the US dollar shows weakness. But I have seen both move up at the same time, especially at a time when we see a potential war breaking out in the Middle East and an escalation of what's going on there. So I think for individual investors to be fearful, to maybe pause and maybe be on the sidelines does make sense. However, when you look at these types of situations, and again, just looking at it from the financial aspect of things, because this is a financial show, these types of events tend to be short-lived and tend to be good buying opportunities. We see over time when we do have wars, or we have big storms that hit the United States, or anything else, any big events, terrorist acts, etc. A lot of negativity out there. The negativity is very short-lived. The market may quickly go to the downside or move to the downside, but then it's always followed by a tremendous upward swing in the markets. The first chart I have for you today clearly shows this. The history of recoveries after a market falls. And I think the main thing for this chart, and for some of you, you may not be able to see it too well, but the red shows a market falling initially based on some sort of crisis. The Great Depression is on the far left, and the inflation spike is on the far right. And the purple actually represents the returns over 10 years after the crisis happens, and that's why there is no purple or green, which is 5 years after, because we don't have that since the inflation spike in 2022. But the main point of this graph is to look at the blue. The blue clearly shows that there is a bounce back. There is a clear bounce back when a market sells off for reasons like a war, like a depression, a recession of some sort, an oil embargo, Arab oil embargo in the early 70s, the dot-com bubble, which happened in the early 2000s. The market always bounces back. And so if we do get something that escalates in the Middle East, I think individual investors should take that as, at some point, as an opportunity to continue to do what they have been doing over time, which is use a pullback in the markets as a buying opportunity. And so I don't want individual investors to try and time this market at this point, wait around to see what Israel does, what Iran does. I think you want to look for good quality investments at all times. And whether or not they're a little bit better quality when the market pulls back for these reasons or not is irrelevant. You just want to continue to look for good quality investments. And I guess the second chart and last chart I have for this segment is one on WTI, or crude oil. And you're going to see here that on the far right-hand side, you'll see the price of oil was moving higher, sort of flattened off, and actually dropped a little bit. And oil is actually down over $1 this morning, down in the $84 range. So even with all this instability in the Middle East, which usually causes the price of oil to escalate, we're seeing oil coming down because I think the market believes that cooler heads will prevail. So once again, if you're an investor today, don't wait for a signal or wait to see what comes out of this. We may not see something for weeks, for months. To wait, as I always say, for it to be blue skies everywhere, you're going to be waiting a long time. Unfortunately, there are always storm clouds on the horizon. We look at what happened in October in Israel, and the market still reached all-time highs by the end of March. So markets will move higher based on earnings, based on interest rates and other things. And I think individual investors, before you sit on the sidelines too long, I think you need to keep that in mind. Now we come to the part of the show that we have every week where I talk about 3 things that I think individual investors should focus on before you make your investment decisions over the next couple of weeks. We always seem to have economic data. I'm going to go over which data I think everyone should focus on over the next couple of weeks. Corporate earnings. As I said, we just started the corporate earnings season. Usually the US kicks off, and then as here in Canada, we follow a few weeks later. Our earnings season kicks off. So right now, for the most part, we had some airlines. United Airlines reported earnings this morning. Very good. Delta Airlines, very good. But we had mainly the US banks. They were the big sector that reported. So we're going to get into corporate earnings and what to look for in corporate earnings. And the third idea, investment ideas, what's working and what doesn't work or is not working right now. And we're going to talk about some specifics at that point. So let's move to the economic data. And really the two things I want to focus on today are two pieces of data that are going to come out in the next week and a half. And that is GDP or growth. Very important. We're going to get growth numbers out of Canada, growth numbers out of the United States, which for the stock market is probably more important. And we're going to get PCE. PCE stands for personal consumption and expenditures. It's another and more preferred way of looking at inflation, the inflation rate. We just got CPI numbers out of the US, which is the Consumer Price Index, looking at prices, how high they're going up and how fast. And we saw that consumer prices in the US have ticked higher, a few ticks higher now, in and around 3.5%, 3.8 on core. Even here in Canada, we just had a recent CPI number, ticked a little bit higher as well, 2.9% from 2.8. So we want to focus on PCE, which is going to be the next measure of inflation, and we want to focus on GDP. And first one, I guess, chart we can show here, real GDP by industry. And you can see here, I guess the most important thing would be the bar chart on the far left. You're going to see GDP as a whole. Then the blue represents private goods and private services and government. And you can see how much growth we're getting, how much GDP growth we're getting in each industry. The next chart, which I think is probably a little bit more important or shows what the expectation for GDP will be out of the US, out of Canada, as our next chart. And you can see how much, or by how much, the United States is growing versus the other G7 countries. You can see that the expectation for GDP coming out in the next, as I said, week or two, is for a number between 2.5% and 3%, closer to 3% than 2.5%. You're looking at a number in and around 2.8% as a growth rate for the United States, well above any of the other countries, Canada, Japan, France, Italy, UK, and Germany. Canada, I guess, second best, coming in just over 1% growth, at least that is the expectation. But really, the United States is the envy of the world right now. They continue to grow. And I guess, unfortunately, for the Federal Reserve, because of that growth, it's causing inflation numbers to be stubbornly high and not come down fast enough for the Federal Reserve. And in Canada, we've seen a bit of a spike up in GDP as well. We were flatlining for a little bit. First couple of months of this year, Canadian GDP has risen as well, affording the Bank of Canada a little bit more time before they may need to cut rates. The next chart we have here, PCE, personal consumption and expenditures, February to March. And you can see here what the February number is, 2.5%, 2.8%. Better numbers, obviously, than the 3.5, 3.8 on CPI. The Fed likes this. Again, you're looking at 2.8 as core, a little bit higher than the overall rate. And again, core strips out volatile food and energy. We have another chart here, which we've seen many times. We've just updated it with the recent inflation numbers out of the US. You're looking, as I said, 3.5% headline and 3.8. And I think the most important thing out of this chart is now when you look to the far right, you can see a bit of a tick up. At one point, US inflation rate was just hovering around 3%. And over the past, first quarter, it's now moved to 3.5. So going in the wrong direction if you're a central bank. You don't want to see that get closer to 4%. or else we may start to hear rumblings of interest rate increases versus when are they going to decrease in the future. Next chart we have Canada's overnight inflation rate versus the Bank of Canada rate. Again, Bank of Canada rate 5%, inflation rate ticking higher to 2.9%. So overall, if you're an investor today, what should you be watching for? What should you be listening for when you turn on the TV and they talk about the business channel here in Canada or in the US? You want to look for obviously nice growth numbers, GDP numbers out of the US, Canada as well, but you want to see low PCE numbers because that'll mean we're still seeing the growth, but inflation is still coming down. Corporate earnings, another, I guess, area that I think individuals need to continue to focus on, especially as we enter into a new corporate earnings season. And right now, as I mentioned, we've had most of the US big banks report. And for the most part, as I said off top of the show, their earnings have been very good, beating on the top and bottom line. We had a few regional banks, big regional banks, beat on top line, but not beat on bottom, but still in pretty good shape with respect to business, with respect to the economy doing well. It's being reflective in the banks. But what I want to focus on, maybe a little bit more in this show than others, is this idea of when corporate earnings come out, what do we need to see? What do we want to see? Well, in a market where, for example, and I have a chart here. I know it's the second chart, but if we can go to that one first. JP Morgan. Coming into earnings season, JP Morgan was on a tear. The stock had run up all the way to $200 a share. And it was, and you can see it here in the middle, it reached $200. It was up from well into 130, 140 range. And here we are, stock on this chart here showing 180. I think, I'm not sure where JP Morgan is trading today, but what happened was because it had such a run up in anticipation of good earnings, when the earnings came out and they were just okay, they beat on the top, they beat on the bottom. CEO Jamie Dimon said things are going well, but there's still a lot of unknowns out there, and the market is still a bit of an unknown because of interest rates and the economy and what could be potential struggles down the road. Stock sold off. It actually sold off by 7%, one of the biggest sell-offs we've ever seen, ever, in JP Morgan after an earnings release. And it was something that caught us all by surprise. We were looking at a stock that was on a great run, still not that expensive, trading at 12 times earnings, but yet individuals took the opportunity to sell the name. And this is what the point I wanted to get at. A lot of individual investors will ask me, why did JP Morgan sell off? We have a chart of Bank of America as well, and we can show that one. And you'll see Bank of America reported earnings earlier this week, and that sold off as well. Again, beating on the top, beating on the revenue growth, beating on the bottom line, earnings per share growth. Stock was actually up when the market opened and then proceeded to sell off. And again, it's that coming into the earnings, they were on a high. They buy the rumor, you sell on the news when the news is released, because individual investors say, okay, well, is this as good as it gets? Maybe it's time to take some profit. The third chart I have here regarding corporate earnings is one on Netflix. Netflix is going to report earnings tomorrow. We're looking for some really good things, but keep in mind, Netflix could be priced to perfection as well, just like Bank of America, just like JP Morgan. For Netflix to really move higher from a price of about $620, near an all-time high, they're going to have to surprise to the upside, and surprise by a fair bit. If they just come in as expected, you may see a sell-off. If subscriber growth to Netflix comes in just as expected or below expectations, you will see a sell-off in the stock. So corporate earnings season, when you come in on a high, when you come in after a point in time where everything has been so good, it sets you up for a bit of a sell-off, even when corporate earnings are good. The third point on our list of three things to keep in mind before you make your investment decisions over the next couple of weeks is this idea of what's working and what's not working. And actually, we called it this segment that, but maybe we should have called it, what do we think is going to work in the future versus not going to work any longer in the future, because that's what we try to do at the Allan Small Financial Group, and really any investment or investment advisor or investor. We're always trying to find out what's going to work. What's worked in the past doesn't necessarily mean it's going to work in the future. And what has worked in the past? Tech stocks. We've seen tech stocks rally tremendously over the last few years. In particular, the 7 biggest tech stocks are what we've known to call the Magnificent Seven, the Mag 7. We have a chart on the Mag 7, which will show you that the Mag 7 continues to work. Maybe not all the names on the Mag 7, maybe only 5 of them are working this year, and we'll get into that in a second, but tech stocks are continuing to rally, and I believe tech stocks will continue to rally moving forward, even if you don't get the interest rate cuts that we all think, even if you get some turmoil out of the Middle East. I think you can find some defense in owning tech stocks today. Now, it's funny. If I said that maybe 10, 15 years ago, people would think I was crazy. Tech stocks are higher risk, Allan. Why are you saying that? Not the case today. Big cap tech, they have a lot of cash on their balance sheets. They're like banks, pretty much. They don't need to borrow money. They have enough money to fund their businesses. They are growing in their businesses, artificial intelligence being a big part of that. Big cap tech is not only good for defense, but it's fantastic for offense as well. And as I've said many times, I think you need to own a few of these names. Obviously, some are better than others. But overall, what's going to work in the future, in my opinion, these are names that are found in every sector. So if you take a top-down look, it's very difficult to say, well, this sector is going to do well, this sector is not going to do well, because individual names within the sectors is where you have to do your homework and research. You could have a name and 2 names in the same sector, one's performing well and one is not for various reasons. So what's going to be working and what's not? Right now, I think tech is working. I think banks are working. Oil has been working very well. Pharma, maybe not so much at this most recent point in time, but it all changes. It'll change with interest rates. It'll change with what the Fed is doing and saying. It'll change with possible issues, geopolitical issues. There could be a lot of changes to what works and what doesn't work. A chart here that we have, as I mentioned, on the Magnificent Seven. This shows which ones out of the 7 are working. Where now many people call it the Mag 5 or Magnificent 5. There you have it. Google, Amazon, Meta, Microsoft, and the biggest winner, NVIDIA. Where have we said that before? And the 2 that are losing right now, Apple and Tesla. Wow, Tesla has been one of the worst performing stocks on the S&P 500 over, well, to start this year. And a lot of people are growing impatient. We're going to get Tesla earnings, I believe, next week, and they're going to tell us a lot about how the company is doing. And lastly, we have a chart on, yes, everyone's favorite stock, NVIDIA. If you've owned NVIDIA over the past year, it probably is your favorite stock. And at one point in time, coming out of first quarter of this year, NVIDIA made up half the gains of the S&P 500. So if basically 10% gains on the S&P 500, 5% of that was just NVIDIA alone. So tremendous stock. And showing the best name, we have a chart on, obviously, the worst performing name, which is Tesla, which we could show, and you could see how much, unfortunately, the mighty have fallen and seen Tesla fall down to the wayside. So 3 things that I think you should be looking at before you make your investment decisions. And of course, they are economic data. We talked about PCE to look at inflation, GDP, which talks about growth of the country, corporate earnings. Remember, be a little cautious. You come in on a high note. Once earnings are released, if they're not blowout numbers, you could see a bit of a sell-off. And lastly, focus on what's working, what's not working in the future, not the past. And if you look at those 3 things, I think you would be set up pretty well for setting up your investment portfolio going forward. So again, we touched on U.S. bank earnings a little bit throughout the show already, and the reason why we touched on it so often is, again, it's a very important sector. Obviously, for the markets, the banks are the bloodline of any country, and obviously the U.S. being the most dominant country in the world. I think roughly 20% or just under 20% of the world's wealth flows through the United States borders every single day. The United States is still the biggest power in the world. And so when you look at how the banks are doing, gives you a pretty good indication as to how the U.S. economy is doing. And as I said, GDP growth, very good, expected to be good this quarter when they release, and that's going to be reflective in the U.S. bank earnings. And I wanted to bring up a few more U.S. bank charts. First one, Wells Fargo, third largest, I guess fourth largest bank, third or fourth largest bank in the United States. You can see here how well the stock has done. It's had a tremendous run up, and when they released earnings recently, they actually were flat on the day. They didn't sell off like some of the other big banks did. Citigroup, which I'll show, I believe we have a chart on that shortly, and JP Morgan, Bank of America, sold off. Wells Fargo hung in there a little bit more. I think individuals weren't expecting their earnings to be as good. So they did surprise. They did surprise to the upside. Citigroup, as I mentioned, another chart that we have here. Citigroup's been on a fantastic run. Bit of a sell-off here at the end. Again, Citigroup actually was up last time I checked today, but it had a run up to about $62 or so, and now it's pulled back into the high 50s again. Unfortunately, Citigroup, even with all their restructuring, can't seem to get out of its own way. We get to this $60, $65 range, and we can't seem to cross it. And book value, value of Citigroup, if you sold off all its assets, everything it owns, they're talking about a book value close to $80. So it's trading well below its intrinsic value or book value. And so a name like this, everybody wonders when will it start to move higher? Goldman Sachs, a slightly different bank. We have a chart on that. Goldman had blowout numbers. They blew the lights out, surprised to the upside tremendously. And this stock actually went higher the day that they reported earnings. So very different than some of the other banks. Obviously, Goldman Sachs, more of an investment bank. They take companies public. They help companies issue debt. They do lots of different things, a little bit on the wealth management side. So Goldman Sachs has definitely had a good run over the past, I would say, few days based on the back of their earnings. Here we have Bank of America. We'll show it again quickly. That sold off when earnings came out. And a different bank that we showcase here every once in a while, PNC Financial. PNC, largest regional bank in the United States. They had mixed results, beat on, I believe, the top line, but not as good on the bottom line. And so mixed results shows a stock that has tailed off a little bit. Keep in mind, this stock, once upon a time, was well over $200 a share way back a few years ago, prior to the regional bank crisis they had in the U.S., I guess would be now a little while ago, over a year ago. So PNC Financial, a great stock to own, pays a great dividend, trades cheaply. U.S. Bancorp, a stock that reported earnings also, mixed bag. And USB, another name that I've been looking at for clients that can handle that volatility. But it's, again, another large regional bank that pays a great dividend and I think has tremendous potential for growth. So U.S. bank earnings, I guess to sum it up, great results, in my opinion, overall in general, but just didn't see the stock prices reflected. And again, I think it's just because they've had a tremendous run higher going into the release of the number. And after the release, I think investors just took profit. Investor expectations. And I think this is always important because as an individual investment advisor, I think probably my most important job or most important thing of my job description would be managing expectations. The worst thing is when you have an expectation that you're going to earn a certain amount of money and then you earn a lot less. It's much better to I guess, think you're going to make a certain amount and over or outperform. That is obviously a much better thing to do, but tough to outperform the market currently. As I mentioned off the top of the show, we came into the second quarter of this year. S&P was up 10.5%. We had the TSX up 6.5%. That NASDAQ, which blew the lights out last year, up just under 10%. So the expectation, well, how long can this last, Alan? Can this market continue to move higher? Well, I think it can move higher, just not at the current pace. And we've seen a sell-off in the markets over the past, let's call it 2.5 weeks in April. We have an S&P chart here, our second chart in this segment. We can show it. It will show the S&P 500 tailing off. And there you see the tail off, because the expectation should be, well, we came in hot. At some point, the S&P 500 is not going to be up 40% for the year. So we're going to do well this year, but things are just going to have to slow down. So there are going to be points in time where the market gives back something. And it's funny because we never know what the reason is for that give back. Is it, geopolitical? Is it higher interest rates? Is it Fed speak? What is going on? Is it corporate earnings? What is going to take this market down, or at least flatten it out for a period of time where we don't see the big gains that we once had? And obviously, market being down in April is because of interest rates, because the Fed has said, well, maybe we're not going to see 3 rate cuts. We're not going to see 5 rate cuts. We're not going to see 3. Maybe we'll only see 1 or 2. Maybe they're going to happen maybe just in the last quarter of this year. So I think that has helped take down this market. So investor expectations need to be correct. What am I saying? Well, I'm not saying sell your investments, because we're pretty much not going up from here. I still believe the market will be higher at the end of the year than it is now. But if you made 10% in the first quarter, maybe you only make 5 to 10% more in the next 3 quarters before the end of the year is done. So maybe that's what's going to happen. Maybe you make another 5-6% over the next 9 months versus 10% in the first quarter. I'm not so sure how that looks, but I think the expectation should be that it's going to slow down, and you have to be mindful of that. As I said, don't try and time this market. Even though the overall market may be slowing down, there are still many individual investments within the index that may have blowout quarters in the next 3 quarters, may be doing tremendously well, and their stock price today is undervalued, and at one day or at some point in time, the valuations will be realized that the stock should be much higher. So don't get caught up on the overall index. I would look more at individual names, bottom-up stock picking, bottom-up investment picking, as more of a way to really share in the gains that we're going to see over the next 3 quarters, and not necessarily rely on that ETF or index, the S&P index per se. An interesting chart we have here that I'll leave you with, investment returns expectations in 2023. And this is really interesting, because what you're going to see is what investors expect versus what investment advisors or financial professionals are expecting. And it's tough to see the writing on here, but I can tell you the orange are the investment professionals and the blue are the investors. So for example, in the United States, investors were expecting a 15.5% return. Financial professionals were only expecting a 7% rate of return. And when you look at China, Mexico, Singapore, investors are expecting similar results to what the investment professionals were thinking. Japan also, pretty big gap between the blue and the orange dot. You look at Canada, 10.5% investors are expecting, or were expecting in 2023, 6.5% were the professionals. So interesting. And if you scroll down, or you can see here at the bottom, you can see that in the US, over 2 times greater were the expectations of investors. The others, Canada 1.6, Australia 1.8, Japan 1.6. So clearly, in a number of these countries, the investors are believing that their expectations, or the market should be able to give them higher returns than the pros were expecting. So overall, understand where we are in the market, understand the environment, understand that you can still make good returns, but overall, the index will probably slow down in the coming quarters, maybe ramp back up towards the end of the year from a historical standpoint in terms of seasonality. But overall, expect the markets to slow down, but that does not mean that your portfolio has to, and we will continue to try and find good quality investments to build as part of, or to own as part of a nice diversified portfolio. I thought it would be good to go over the 5 things that I think right now that I'm a little bit fearful of, that I think can kind of bring down the positivity of the market, bring down the market in general. And these are the 5 things that I wanted to touch on just briefly today: inflation and interest rates, geopolitical concerns, corporate earnings, market valuation, and of course, a list wouldn't be complete unless we spoke about the second largest economy in the world, which is China. So inflation and interest rates. Clearly, if inflation were to start to move higher, it already has moved higher in the US and even ticked a little bit higher in Canada. If inflation were to move higher, it will clearly or obviously take interest rates higher with it. We've seen the 2-year rate in the United States recently, with the recent uptick in inflation, touch pretty close, or I think it actually touched 5% briefly. We've seen the 10-year get up to about 4.6, 4.7 on the 10-year government bond rate in the US, and that's because inflation has gone from 3% to about 3.5%. Core rate seems to be still slowly but surely coming down, but inflation is not moving as quickly to the downside as much as the Federal Reserve would like to see. We have a chart here on inflation and interest rates, and you can see here the orange dots are the inflation, and you can see that the blue graph, the blue chart here is the S&P 500, and that's over almost 100 years of data. So you can see that inflation has been relatively low for most of the time. When inflation spikes up a little bit, at times we can see the S&P 500 sell off. The second point I wanted to touch on that could take down this market or cause problems for the market: geopolitical events or geopolitical concerns. And we spoke a bit about that off the top of the show a little bit earlier in the show. I have a chart here that talks about market crises and subsequent returns. And I think it's a great chart. You can see here market-related decline in the second column. You can see all the big negative numbers, months to recover. You can see how long it took. And then 1 year later, look at all these returns. September 11th was the one time that it still showed a negative 1 month or 1 year later. And then 2 years later, it was up by almost 7.5%. But outside of that, 1 year later, all the returns are higher. So geopolitical events, what happens in the Middle East, definitely going to play a part, or an important part, as to how the markets do. The uncertainty, the oil, right? If there's a fear that, if Israel were to attack areas that Iran is storing their energy, their oil that they export to China and various countries, that obviously could present an issue and a spike in oil prices. So geopolitical events, I think you need to be mindful of that, and I know a lot of people are. The third thing would be corporate earnings, and a great chart, my favorite chart of the show. And I always have a favorite chart of the show. We'll show that here. Snapshot of the S&P earnings beat rate. And you can see here, on average, corporate earnings beat, let's say, in that 70 to 80% range, sometimes above 80%, as you can see here, but a 70, 75% range. And we'll see what the earnings beat percentage is this time when we have corporate earnings come out over the next, let's call it, couple of months. And but I think that if we do get corporate earnings disappointment, top and bottom line not meeting expectations, or maybe even, as I said earlier, they just come in as expected, we could see a bit of a sell-off here, and it's a sell the news phenomenon, right? Stocks running up into the release of their earnings and then selling once that release happens, even though they may have good earnings. Market valuation, point number 4. Market valuations continue to surge because earnings aren't growing as fast as the price of the stocks. We could see a bit of a sell-off. Right now, PE ratios for the S&P somewhere around just around 20 times, which is historically a little bit high for the market. We have an S&P 500 PE ratio chart, which we'll show you here. You'll see a huge spike. I believe that spike is in the early 2000s. There it is. But you can see on the far right-hand side that the chart is definitely moving to the upside. So we are seeing valuations moving a lot higher in the last, let's call it 6 months or so. We went from a market that was oversold to now in many areas a market that's been overbought. So if valuations continue to rise, I think that could be an issue for the overall market. And last but not least, my fifth point is China. And we have a chart on China, which we can show. China GDP growth, obviously very important for how the markets do globally around the world. You can see here that the growth in China has been a lot higher earlier on. Years ago, it's definitely come down, and they're struggling. They're struggling with growth right now. They're struggling with this issue with the United States, this tit for tat sort of thing. The United States doesn't want to send them the best quality chips to build out their artificial intelligence. And then China says, well, if you're not sending us, your companies aren't sending us your chips, we're not going to allow our companies or government to use Apple iPhones, or we're not going to, allow PC companies or companies that provide chips for PCs like AMD and Intel to provide chips to our companies that are building these computers. That we're going to use our own chip makers in our own country. So Micron, another chip maker that has had a boycott of some of their products. So a lot of our semiconductors really feeling the pinch with regards to this tit for tat between China and the United States. So for me, I think it is an issue. It can be an issue if there continues to be an escalation between the U.S. and China. This whole idea of China is the number one competitor of the U.S. and the U.S. is going to, I guess, protect or not allow U.S. companies to continue to export whatever they want to China. Well, you can bet that China is going to do certain things to retaliate on their side as well. So those are the 5 things that I think individual investors, again, should keep an eye on that potentially have the ability to take down this market, at least for the short term, until cooler heads prevail. So as I mentioned off the top of the show, the budget was released yesterday, just around 4 o'clock, just after 4 o'clock. A bunch of things were there, and I don't mean to diminish all the other things I'm not going to get to today. Perhaps if you have a question on any topic regarding the budget, you can put it in the chat box now, and perhaps I get to it in our question segment at the end of this show, which is coming up right after this segment. Or feel free to send a question in throughout the next couple of weeks, and perhaps we can answer it on our next show. But the 2 areas I wanted to highlight for the budget is this idea of the federal government really focusing on housing, and they're setting aside billions of dollars to go towards building affordable homes, because like our provincial government, and as you all know that watch the show, I had on the Premier of Ontario talking about housing here in Ontario, Premier Doug Ford talking about flooding the market with housing. The only way increased supply to get housing prices down, he feels the only way to get housing prices down, and I agree with him. So a lot of money, the provincial level, federal level, is going towards housing. Unfortunately, though, the second point that I wanted to touch on that also came out and individual investors are already asking me about, I received already text messages, phone calls about, is how is the federal government going to pay for all this? As the question we always ask, right? We're running a larger and larger deficit in this country. And now apparently the interest expense on the debt that we have in this country actually is greater than the amount of money we spend on healthcare on an annual basis. So it's getting up there. Look at the United States. They're spending over $1 trillion in interest payments based on how much debt they have. So the debts are definitely racking up, unfortunately. And so what did our federal government do? Well, they decided to, once again, unfortunately, talk about how the wealthiest in our country aren't paying their fair share. And they talked about raising taxes on corporations, on trusts, and on individuals that make a certain amount of capital gains on an annual basis. And they talked about capital gains going from 50% to being taxed 66% of the capital gain versus the 50% of the capital gain. And we have a chart here on capital gains in the federal budget, which can quickly summarize or hopefully give you a little bit of an example. So for those that on an individual basis, if you're making more than 250,000 of capital gains in a year, then your capital gains rate goes up to 66% or 2/3 versus being taxed on only 50%. So yes, that probably won't affect many people. Not a lot of people have $250,000 of capital gains personally on an annual basis. But what the federal government then did was increase capital gains tax on businesses, corporations, trusts. So if you're a small business and you have excess capital and you don't know what to do with it, you don't need it to run your business, you've probably been investing it. Or if you haven't, you should have been investing it. Now the capital gains that you make on those investment dollars are now taxed. 66% of those gains are now taxed versus just 50%. So corporations, unfortunately, are now going to be taxed at the higher rate. When it's all said and done, it comes out to about 10% more that these businesses, these trusts, because trusts are included as well, are going to be paying on their money that they make. Is this fair? Are businesses going to complain? Well, we've already heard from TD Economics. I heard this morning that they were talking about productivity and that this is not going to help businesses trying to become more productive. It may be a bit of a deterrent to people opening up a business or businesses coming to our country if they see capital gains tax being increased. So we'll see what types of ramifications this, I guess, increase in taxes are on businesses, on the, highest earners in our country. As the Premier has said on my show, he does not believe in taxes. And taxes, in fact, I think he said he hates taxes. Taxes are definitely not the way to go about things. Obviously, our federal government does believe that taxing a portion of the population will allow them to continue to spend the money that they need to spend. And there lies, I guess, the differences of opinion. So overall, that's the two main highlights, in my opinion, that stood out to me when I saw the budget. But again, we'll delve into the budget a little more and stay tuned. We will have a little bit more on the budget, perhaps on our next show. So my favorite part of the show, again, is when I get to answer at least one question from the audience. And I was noticing a pretty good one here, kind of talking a bit about what I was just speaking about, which is the US and Canadian debt situation is getting scary. Is this a problem? What's the potential impact on my investments? Great question, kind of fits in with our tone. And I would say right now, it doesn't affect your investments, at least not directly. However, the more money the US government, the Canadian government spends, the more bonds they have to issue to raise the money to spend it. When you issue more bonds, it definitely has an effect on interest rates. If people aren't buying the bonds or buying the debt that you need to issue to pay for all this stuff, then that's a problem. If people aren't going to buy the debt that you're issuing to raise the money, then you have to raise the interest rates on that debt. And therefore, the more you raise interest rates, the higher the rates go, the worse it is for the stock market, of course. And that's what we've seen especially in the US this past year. They've had a number of bond auctions that didn't go well, where interest rates actually went significantly higher, and that unfortunately took down the market. But overall, countries like Canada and the United States, high debt levels, but they continue to be able to borrow in the open market. So for now, it doesn't affect us too much, but generations to come, if the debt continues to rise, become more and more a part of the money that we take in, and at some point be bigger or larger than the money that these countries take in, then obviously at that point, it might be too late to fix the debt issues. So with that, I want to say thank you to everyone for joining me today. It's always a pleasure to speak with you and talk about the topics that I think are important and answer the questions that all of you or many of you may have. I want to say that I think you should catch our next episode, which is in 2 weeks, Wednesday, May the 1st at 12 noon. We have Bob Tapscott. He will sit down to talk with us everything about artificial intelligence, all the questions that I have, some of you may have. If you have them, send me those questions before our next show. We're going to talk all things AI. I think it's so important. We're going to talk about generative AI. We're going to talk about all kinds of things, try to make sense out of what's going on and why this market is going totally bonkers regarding AI. So until then, send me your questions and happy investing.